Here's a headline for you from Marketing Dive. Unilever acquires Dr. Squatch, valuing brand's viral marketing to Gen Z men. The DTC grooming upstart was praised by Unilever for its social-first approach, which has recently included racy ads with one Sydney Sweeney. So, the Marketing Dive broke out into things you need to know, the bullets. Here they are. Unilever is acquiring men's personal care brand Dr. Squatch from private equity firm Summit Partners, according to a press release. Financial terms of the transaction were not disclosed. The deal is part of the CPG giant's efforts to align its portfolio around premium and high-growth verticals. Unilever praised Dr. Squatch's, quote, built-in culture brand, which has been established through viral social media marketing and partnerships with influencers and celebrities. Unilever is broadly ramping up its spending on social media and influencers to reach different global markets and consumer groups. Snapping up Dr. Squatch also sees the company return to the DTC acquisitions, a strategy that has not always panned out. So, Mike, big companies like Unilever are pulling the DTC lever once again. What are your thoughts?
The more things change, the more they stay the same. But I really will be interested in seeing what the move is here because, listeners, if you'll remember, Unilever acquired the Dollar Shave Club once upon a time when a couple of really funny and bold YouTube videos threatened to upend what had been a stable vertical for decades and decades. And to their credit, Unilever really developed that into like a branded house unto itself, so much to the point where actually about a year and a half ago, they sold that as an asset. So that's just a very interesting full cycle, and now we begin again. So I'm very interested to see what the play is here.
Yeah. You know, it's funny to me. Like, you wonder what the financials are showing these big businesses. Because it's not just Unilever. Everybody is doing this,
absolutely.
You know, and I guess from the outside looking in, you would think it would be cheaper to sort of just develop your own internal brand and push that out than it would be to buy a competitor. But a company like Unilever has all the resources, all the money in the world. They're doing the data, you know, they're crunching the numbers, and they're finding actually, the amount was undisclosed here, but these are usually figures that are in the billions with a B. So let's say $1 billion, $1.5 billion, $2 billion. They felt it's better to throw out $1 billion and buy this brand rather than developing one. And they're not the only ones. Like I said, look at the trends. I mean, Meta comes to mind for me.
Absolutely.
You know, Meta prior was Facebook. What happened? Instagram came on the scene, was taking away engagement users from them. What did Zuckerberg and Facebook do? They bought up Instagram. WhatsApp was gaining a lot of momentum.
Absolutely.
Facebook went in there. Now Meta took WhatsApp. They've done it with Oculus. You know, and again, these are huge companies with a lot of resources. So clearly they're seeing that it's a better play to just buy this pre-established thing than to try and build your own.
Yeah, these are not risky businesses.
Exactly.
Shout out to Tom Cruise. These are not wild guesses they're making. They know what they're doing. And you know what? It got me thinking that, you know, you look at a brand like Dr. Squatch, and it's not just a product. You know, you can't just, you know, you take a look at Instagram, and yes, could they have done a photo filter social site? There's that magic. There's something, you know, there's something that intangible. And maybe that is kind of the unspoken value that these larger brands are seeing. And, you know, if you can't beat them, join them type situation.
It's also changing the game for startups.
It really is. And I'm very glad you brought that up. One thing that I'm interested in seeing how it develops, let me put it that way, is more and more I'm seeing startups that from the outside seemingly were made to be sold off.
Yeah.
And that changes everything. If that's the goal, that changes everything in terms of product development, in terms of quality assurance, in terms of how you market and how you speak about it. That's got me interested.
Yeah, we actually have professional experience.
We do
with
indeed.
This. You know, we've been, prior to the podcast, working in the multimedia world here at the ANA for a long time.
Yes, indeed.
It's not too long ago that we had an AI-powered video editing tool. I'm not going to name names, but it was an upstart, you know, smaller tool trying to build an audience. I think we got in on the ground floor. We adopted it within the first 3 months of it being launched. It was great. We loved it. I mean, quite honestly, loved it. after a year, it was sold and it was kind of just went away. And we've been looking for a similar solution since and haven't found one that was as good or as satisfying as that one was. So we actually were sort of, I don't want to say victimized, that's a little dramatic, but we do have some experience with a startup product that we loved and wanted to continue using, and it was sold off and kind of just went away, and we haven't really found a solution since.
Yeah. And listen, I get it. Jeepers Creepers, you've done all of this work on a startup and the opportunity to cash out and see all of the rewards for your hard work.
Again, yeah, when the figures are in the billions, I mean, yeah.
Make that paper, boo-boo. Like, but it really will see how whether or not trust in startups starts to change.
Yeah, that's really interesting.
Whether there's this assumption that you started this to cash out.
Yeah.
Yeah,
that's a good point. But, I guess at the end of the day, Unilever, an already very big company, just got a little bit bigger.